Hello, hello. Welcome to another Wednesday Wisdom Day. And today we're going to talk about how to Section 1031 into a DST, a Delaware Statutory Trust. And I know we've been talking about a lot of real estate. And I know some might argue that the real estate is going down or it's down right now. There's some really great strategies that you can still deploy. And now is probably the best time to really look at what can you do, what kind of options do we have in a market like this. So as many of you probably already know, the Section 1031 tax deferred, it's a like-kind exchange, is one of the greatest wealth building mechanism for real estate investors. And the reason why is because you can avoid tax in all your property upgrades during your lifetime and then pass it on to your heirs when you die. Now, when the heirs receive the property with the step up to fair market value, they can likely sell the property and pay no taxes, right? Because of that. So that's why it has been used extensively over the years. So it has its proper place in real estate investment and wealth building. Now, what if you want to get off the landlord bandwagon, right? So there are a couple of options, and I'm just going to list them today, and we're going to talk about one of them. You can use an UPREIT. You could invest in Opportunity Zone Fund for as long as we still have them, or you can invest in a Delaware Statutory Trust, and we're going to go a little bit in more detail what that is. Now, over the years, I've seen, a lot of clients, a lot of people that came, to have conversations with, and they had really bad experiences with DSTs, which they felt it was not really good. It was not a good investment. It was the worst choice. And I think most of it is because of lack of knowledge what that really is. So let's go to really quickly recap what is a 1031 exchange. So to just make sure that we're on the same page, the basics of 1031 is pretty straightforward, right? Before you sell an old asset, you must begin that exchange with, contracting a qualified intermediary, right? You can't do it. You have to have that in place. Then you may list up to 3 potential replacement assets within 45 days of the sale of your qualified asset. I know there's a lot of words here, but like you have 3 replacements for the property that you want to dispose of, right? Then you must close on at least one of those 3 assets within 180 days of the sale of the property you want to dispose of, right? You want to sell. And for the exchange to be fully tax-free, you must acquire an asset, a new asset, or multiple assets that have a value of more than the one you're selling, not the gain, more than the selling price. Okay, if not, then you can get some taxable gain. Okay, so that's the basics. Now, just to make sure that we're on the same page on the 1031, let's go over what is a qualified 1031 asset, because that would tell us how can we exchange into a DST, right? So 1031 assets would be residential, commercial real estate that you're holding either for investment, rental, business use. Okay. You can have raw land held for investment. You can have tenant in common held real estate, or you can have Delaware Statutory Trust interests. Okay. Ding, ding. That's our cue. They're assets that don't qualify for you to, they don't qualify for Section 1031. Some of these would be securities, stocks, bonds, partnership interests, assets that you hold as inventory, personal use real estate, or foreign real estate. Very important. So we've got the basics. Okay, that's 1031. Now, let's look at what is a Delaware Statutory Trust. Now, you have to understand that Delaware Statutory Trust actually, has an ownership structure that allows you to own a fractional interest in a large institutional, quality, and professionally managed commercial property along with other investors. Because this is a trust, you are an owner. Because you are an owner, you have ownership interest, that makes the investment in a DST a qualifying replacement asset for purposes of 1031 exchange. Okay, we can go in details on this, but we're going to leave it at that. So some key thoughts about DSTs that I want you to, and about DST investments that you can actually remember. Things that we want to take into account if this really makes sense for what we want to do, and how we can look at the taxable events that we're creating in the year we sell a property that we might not be able to do 1031 exchange. Okay. So one of the key elements is liquidity. DSTs, they don't have a secondary market. That means your money might be locked up in this investment for up to 10 years. Okay, that's one. Minimum investment. Generally, for you to be qualified as to be qualified investors into a Delaware Statutory trust, you have to be an accredited investor. That means one or two things. Either your income is 200,000 or more, or if you have a spouse, 300,000 over the past couple of years, and you can expect that you have the same in the current year. Or number two, you have a net worth that exceeds 1 million without and excluding your primary residence. Okay, so that's how you get a minimum investment. You have to be a accredited investor. Number three, lack of control. Unlike the property you own yourself, you don't have control over the property, right? In a DST. That means you don't have the headaches and the day-to-day responsibility of a landlord. Number four, leverage. Okay. You've heard the saying that, once you use other people's money to increase your rate of return, that's called leverage. Okay. So in real estate, this is very common and it can work. But if you had no mortgage, a real example, if you have no mortgage on your 1031 property, now you probably want to consider investing in a non-leveraged DST to reduce the risk that you can lose your investment. Okay, that's lever number four. Number five, back up for the 45-day rule. So when you remember when we talk about 1031 exchange, and you have to identify up to 3 properties under that 45-day rule, and you have to close one of them within 180 days. So if you only have one or two, you play with fire. So if you are looking, for example, naming 2 properties, using the DST as a backup. So you would have 2 exchange properties that you can have, and the third option, you can use a DST as a backup if nothing else works. So should all the other properties fail to close for various reasons, then you use your DST to preserve your tax deferred status and live to play the Section 1031 some other day. Okay. Number 6, we have parking your investment. That's probably one of the most common uses that I've seen for DSTs. When nothing else works, people just think, I'm going to park it. So if you think the market of buying a property will be better, 7, 10 years down the road, you could do a Section 1031 exchange into a DST as a way to just park your investment. So I hope these 6 items are really shedding some light for you in doing a 1031 exchange into a DST. So some of the takeaways that I want you to take today are, if you want, or you're forced, whatever the reason, to get out of that landlord, bandwagon, the DSTs can give you several options, right? So it allows you to sell your investment, real estate, and defer the federal taxes without having to take the burden of owning and managing a new piece of real estate. Okay, if that makes sense for you. And remember, we talked at the beginning, there's alternatives to DST. It's not the only way. As an alternative, you may want to look into an UPREIT or investing into an opportunity zone fund. So I hope this is useful. Guys, you have an amazing week. I'm looking forward to see you again on Wednesday Wisdom for exploring more on the 1031 exchanges, on the real estate strategies that we have. You guys have an amazing week.